How to retire in 10 years by investing in stocks. Welcome back to our channel. Today, we are here to talk about how to retire in 10 years by investing in stocks. But before we get started, subscribe to our channel to never miss a stock update. So without further delay, let's get started. Decentralized time investment is an investment strategy similar to diversified asset investments. It is a wrong investment strategy to invest all of your savings in a certain stock. For the same reason, limiting the exposure of stock investments to 1 year is also reckless behavior. If the investor made this mistake and the stock market experiences a cliff-like decline during the cycle, then he would lose all of his money. Spreading time investment will extend the investment cycle to decades and investors will be safer. Most investors are not good at extending the investment period. Regardless of the factor of inflation, looking at the absolute amount of investment alone compared with old age, many people's investment amount is very small when they are young. Taking inflation into account, the amount of stock investment for most investors in their 60s is 20 or even 50 times higher than in their early 20s. When you are in your 20s, you invest thousands of dollars, and when you are old, your investment is dozens of times higher. Relatively speaking, small investments when you are young cannot diversify your future investment risks. From the perspective of diversifying time investment, the investment you make when you are in your early 20s or 30s is most negligible. When I was young, I invested $50,000 and then I invested $1 million when I was old. This investment model is unreasonable. We have to consider investing $100,000 when we are young and $950,000 when we are old. Comparing the two investment models, the overall market exposure is the same, but the latter has achieved diversified investment in time. Many people have missed the 20-year cycle of diversifying investment risks. Our investment career could have diversified investment risks for 40 years, but most people focus their investment on the 10 to 20 years before retirement. To solve this problem, we propose a simple but seemingly radical investment philosophy. When you are young, you must use leverage to buy stocks. Spreading time investments means increasing the amount of investments when you are young. When young, everyone generally lacks money on hand, so they would not invest heavily. Because of this, we need leverage trading. Leveraged investments, when you are young, is a more prudent investment strategy. If an investor's lifetime exposure to the stock market is quantitative, then increase the exposure to the investing in stocks when we are young, and gradually reduce the exposure to stocks as they grow older, so that investment risk can be reduced and time investment can be diversified. Understand the investment law of spreading time. Spreading time investment can reduce portfolio risk by 21%. This kind of investment strategy is more sensible. We use the information on the book value of the asset to prove it. Based on the analogy, the traditional investment strategy allows you to obtain a retirement reserve value of $749,000, but its potential investment risk is greater, and the final investment return has a greater range of fluctuations. How to measure risk? It is a good idea to list the results with a probability of 95% and see how many differences there are. We have to judge the pros and cons of investment strategies based on the results. Using traditional investment strategies, the volatility of investment returns will be as high as $490,000. If you adopt a life cycle investment strategy, you can get the same retirement reserve of $749,000, but the volatility of investment returns is reduced by 21%, or $105,000. In other words, when the investment situation is good, your return will be $105,000 less. In the case of poor investment prospects, your return will be $105,000 more than using traditional investment strategies. According to traditional investment strategies, the net value of retirement reserves is only $259,000 at the worst. With a life cycle investment strategy, your retirement reserves can hold $364,000, and you can maintain a better investment mentality. The result of such an investment sounds too good to be true. A certain TV commercial that airs at midnight may sell you exuberant real estate, saying that you can make millions of dollars in net profit without losing money. It sounds obvious that the advertising operator is operating. However, the diversified time investment strategy is not an advertisement. It directly applies to the Nobel Prize winner Paul Samuelson. The research results of Robert Merton. We will explain the relationship between the life cycle of investment strategy and the research results of the two scholars in Chapter 1. Having said that, I hope that you will not believe in the words of the big stock market masters and do not believe in some boastful remarks. The strategies presented in this book are well-founded and have been verified by historical and analogical data. Believe and continue to verify. No matter how reasonable it seems at first, and no matter how many people say it, you cannot rely solely on a certain theory or common sense of investments to invest. Because you use your money in your retirement account, we need to look at the results of specific data. Stock market data from 1871 to the present have verified the effectiveness of life cycle investment strategies. The results of each verification show, including during the Great Depression in 1929 and the stock market crash in 2008, that our diversified investment strategy has achieved better returns than traditional investment strategies. The 2008 financial crisis has left investors with lingering fears. The Standard & Poor's 500 index fell 38%, and the intensity of daily stock price reversals was unprecedented. When the stock markets fluctuate strongly, the role of diversifying time investment becomes more pertinent. The greater the volatility of the stock market, the more necessary it is to diversify investment. Our simulation results show that in the current market, for those who are about to retire or have already retired, leveraged life cycle investment strategies are far more useful than traditional investment strategies. For those fledgling college students, losing money at the beginning of their investment will make their investment more challenging. But because they are just starting, there is nothing they can't afford to lose. The greater the investment exposure when you are young, the more you can reduce your stocks and exposure before retirement. This method also applies to the 2008 financial crisis. The best case of the spread time investment method: buying a house. Buying a house is a wise long-term investment, and one of the reasons is that the time spreading investment strategy is very effective. People's investments in buying a house and investing in retirement funds are similar in the same way. You use the borrowed money to buy a house, although you can't borrow too much. As the loan is paid off, your leverage gradually decreases. Investing in buying a house is naturally a time spread investment because sooner or later, everyone has to invest money in the real estate industry to buy a house. Even if you have just turned 20, you have to use a down payment of $25,000 to buy a house or apartment worth $250,000. Although your house was mortgaged to the bank, you still put $250,000 into the market. Owning a real estate, you will bear relatively stable investment exposures throughout your life. Buying a house alone is equivalent to making money in the real estate market that you may not make for a lifetime. Why? Because the funds they put into the real estate market are exposed to risks and stability, and they will last their entire lives. Owning real estate is a way for people to diversify their time investment. This is one of the hidden benefits of buying a house. It is no accident that real estate has become the biggest asset for many people after retirement. The problem with buying a house is that it makes people lose the opportunity to diversify their asset investment. Owners are willing to invest in diversified time, but the market risks they have to bear depends on a single real estate. That is, the stock of a certain real estate company. The best choice for investment is to diversify asset types and diversify time investment. Our leveraged stock investment strategy has these two characteristics. Due to the need to invest in a variety of stock portfolios, we have invested in diversified assets. At the same time, we have to ensure that even if the investors are older, they can manage a larger stock position. This is a diversified time investment. Many people can afford a 10-to-1 real estate leveraged investment, but few people are willing to trade stocks with a 2-to-1 leverage ratio. If you buy a house in the same way as stocks, people will have to wait until they have enough money to pay in full in cash before buying a house. In this way, a person is very lucky to be able to buy a house before his 50th birthday. We propose that stock investors should be treated as a mortgage to buy a house. The recent collapse of the property market has tragically proved that housing prices will not only rise or fall. Buying a house with leverage ratio of 5-to-1 or 10-to-1 is a prudent pension investment method. But this does not mean that you can use the leverage ratio of 20-to-1 or 100-to-1 or even a mortgage loan that exceeds your monthly payment limit. Go buy it. You have to invest in this way, and the house price will have to skyrocket every day to achieve refinancing. Excessive leverage or debt can lead to unnecessary risks. Of course, we cannot conclude that it is the best way to exclude leverage transactions and not buy a house with a mortgage. Too high or too low a leverage ratio will lead to unsatisfactory investment performance. We are not asking everyone to go to the extremes to buy some stocks with a down payment of 5% or 10% of the face value. You can buy stocks with 50% of the funds when you are young. Taking on a small amount of leverage trading when you are young will greatly change your life because the return on investment increases with compound interest over time. Einstein believed that the most powerful force in the universe is compound interest. Whether the sentence comes from Einstein is worthy of scrutiny, but the truth is very useful. When people have missed a lot of investment opportunities in the first 20 years of work, which will greatly reduce the net value of their life investment returns. If the key factor in buying a house is location, 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 then the key to buying stocks is to be dispersed. Without leveraged trading, you cannot achieve diversified time investment. Starting leveraged stock investment as early as possible will make you bear greater market risk at that time, but it can greatly reduce your lifetime investment risk. Although the sentence sounds contradictory, it is an effective investment method. Not only can the expected retirement reserve be increased by as much as 50%, but it can also greatly reduce the risk of poor investment results. Using leverage to buy stocks can ultimately reduce your investment risk. When we first made these points in the column of Forbes, we received letters of protest from many people. Someone wrote to complain that we were encouraging everyone to take risks in the stock market recklessly. Investment gurus will never propose this way and shouldn't invest this way. For example, Susie Orman's investments in stocks will not exceed 10% of her property. Even if the most radical situation, investment masters will only suggest that you invest 85% of your deposits in the stock market and reduce it year by year. So that's all for today, guys. Thank you for watching the video. If you've enjoyed it, make sure to hit the like and subscribe button. Let us know your thoughts in the comment section below. Until next time.